It is Wednesday, June 24th, 2026, and this is The High Road, Logistics and Leadership. I'm Jules Sterling, and I keep the contracts from unraveling.
I'm Dan Miller.
And I'm Buck Reynolds.
This is Elena Rossi. We have a great show for you today.
We have a packed episode today. Just a total mix of high-level finance and some real-world grit on the ground. Sort of a snapshot of where we are mid-year, right?
Look, it's a wild day. We're seeing these crazy contradictions in the equipment market and some massive shifts in how the big players are hedging their bets. Let's start with the numbers. The ATA just dropped the May tonnage index, and it's a bit of a head-scratcher. Tonnage fell 2% in May, following a dip in April.
Here's the deal. That's the seesaw we've been talking about, right?
Exactly. We had a strong first quarter, but now Bob Costello at the ATA is saying the goods market is just all over the map. Manufacturing is inconsistent, construction is soft.
Actually, the services sector is doing fine, but that doesn't put freight on a trailer, does it?
Right, it doesn't. But here's the kicker. While tonnage is cooling, trailer orders in May surged 237% year over year. That is an absolute explosion.
Wait, that's sort of contradictory, right? Why buy 20,000 new trailers if the tonnage is dropping?
Bottom line, it's a replacement cycle. Carriers are racing to lock in inventory before the Q3 cost wall hits. They're betting on a second-half recovery.
The thing is, if you're an owner-operator, you don't just buy a fleet on a bet. You do it because you see the capacity tightening up.
Or because they're terrified of the upcoming tariff-related price hikes, which, you see, is the real driver here.
Speaking of hedging bets, look at UPS. They just announced a $48 million investment into 27 temperature-controlled cross-dock facilities across the globe.
Now that's a power move.
Right? It's a surgical strike on the pharma market. They're specifically targeting the GLP-1 boom. The Wegovy and Ozempic craze.
Those things have to stay cold, right? One temperature excursion and the whole shipment is trash.
Exactly. And that's why every single one of these sites is IATA CEIV Pharma certified. They're moving away from commodity volume and chasing high-margin precision logistics.
If I may, that's the only way to survive the parcel volatility. You move into biologics, where the cost of failure is so high that the customer will pay whatever you ask.
It's a total pivot to yield over volume, sort of like how we've seen them trim the fat in other areas, right?
While UPS is building fridges, the government is building reactors. The DOE just committed $17.5 billion in loans for 10 new nuclear reactors.
Nuclear? For trucks?
No, Buck, for the AI data centers. Look, the bottleneck for AI isn't the code anymore. It's the power. The grid can't handle the load.
It's a massive infrastructure bet. They're even restarting shuttered plants like Palisades in Michigan to get 24/7 carbon-free power.
Right, and that's where the transportation angle hits. We're seeing a push toward software-defined vehicles. Accenture and Coratura are teaming up to reinvent how commercial trucks are built.
Here's my thing. You can't software update a cracked frame or a blown wheel bearing. I'm still skeptical about these silicon drivers.
I get that, but the efficiency gains on uptime are real. If you can fix a compliance issue over the air, you're not losing a day of revenue.
Let's switch gears to the labor side. The Teamsters just had their Independence Day. The DOJ and the union filed to end that 37-year federal oversight decree.
37 years? That's a long time to have a babysitter, right?
It started in '89 to purge the mob influence, the La Cosa Nostra stuff. But now Judge Preska is expected to sign off and let them fly solo.
Actually, the concern is whether their internal disciplinary system is actually more stringent, or if they're just removing the transparency.
Look, Sean O'Brien says it's a new era. An autonomous union is a more agile negotiator, which means they might get even more aggressive with the national master contracts.
Bottom line, if they're more agile, the carriers have less time to react to a strike threat. That's a risk factor for every major fleet in the country.
And speaking of risk, let's look at the East Coast. CSX just opened the Howard Street Tunnel in Baltimore for double stack service.
I saw that. Governor Moore was there for the ribbon cutting. It was a $495 million project, right?
Right. They lowered the track bed by 18 inches. Sounds small, but it removes the final single-stack bottleneck from Massachusetts all the way to Florida.
That's a huge efficiency gain. We're talking about adding 160,000 containers a year to the Port of Baltimore.
I mean, the thing is, it saves over 1 billion truck miles over the next 30 years. That's a lot of wear and tear off the I-95.
It definitely shifts the competitive landscape against New York and New Jersey, but only if the rail yards can actually handle the surge without collapsing.
Hey, before we move on, a quick note from our sponsor. Strategic logistics requires world-class engineering. This show is powered by the stack developed by Eric Christensen at Neural Network Media. Support the architect behind the code. Visit our Patreon at patreon.com/Neural Network Media for a free trial and access to our daily briefing PDF. All right, let's look at the global picture. The Swiss breakthrough. The U.S. and Iran signed a peace deal, and Brent crude just plummeted below $76.
That's a massive relief. We were seeing peaks of 114 during the conflict.
Right. And the U.S. Treasury gave a 60-day license for Iranian oil to hit the market. We're talking about an extra 1.5 million barrels a day.
Finally. I mean, fuel surcharges have been killing the small guys. Oh, I bet the insurance companies are still charging a war premium for the Gulf.
They absolutely are. And they should be. Because while the oil is flowing, the trade policy is turning into a tariff wall.
Right. The EU is closing the hybrid loophole. They're slapping 17 to 35% tariffs on Chinese plug-in hybrids because BYD is just flooding the market.
It's the era of reciprocity. You tax my EVs, I tax your hybrids. It's a trade war with better batteries.
Speaking of wars, let's talk about the physical security crisis. The IMO just started evacuating 11,000 seafarers from the Strait of Hormuz.
11,000? That's a lot of people stuck in a bottleneck.
It's a nightmare. And while the Royal Navy is clearing mines, we've got Russian drones hitting cargo ships in the Black Sea. The Victress took a hit overnight.
That's terrifying. And it's not just at sea. Amotech is leading a nationwide mobilization in Mexico today because of the hijacking surge.
Exactly. Over 3,000 violent hijackings in the first half of 2024, and it's getting worse. They're targeting high-value electronics and AI servers.
Bottom line, if you're hauling $10 million in chips, a standard insurance policy is a joke. You need paramilitary security just to get to the border. On a brighter note, Orange EV just hit a milestone. They deployed their 2,000th electric terminal truck to Coke Canada bottling.
2,000? I thought these things were just for the green PR.
Look, the data says otherwise. They've hit 33 million operational miles with a 97% uptime rate.
That's actually impressive. Sort of proves that yard dogs are the perfect use case for electric, right?
Exactly. They're not crossing the Rockies. They're just moving trailers in a fenced lot. The efficiency is there, and the cost is dropping.
And the automation is moving into the warehouse. Amazon just unveiled Proteus. It's an autonomous robot that uses conversational AI.
Wait, you can just talk to it?
Yeah, you give it plain language prompts and it handles carts up to 400 kilos. They're also rolling out Vulcan, which has haptic sensors. It can actually feel the items.
All that tech, and yet they're still fighting the de minimis loophole. The US closed it, and now the EU is following suit.
Right. The era of duty-free shipments under $800 is over. It's a total blow to the low-cost e-commerce model.
Now it's time for Iron Lady's Verdict, our Wednesday segment where we break down the legal fallout of the week. Good morning. I'm Elena Rossi, and this is The Verdict. For years, freight brokers have operated behind a federal shield known as FAAAA preemption, a legal get-out-of-jail-free card that blocked state-level negligent hiring claims. That shield didn't just crack, it was vaporized. Following the U.S. Supreme Court's unanimous decision in Montgomery v. Carib Transport 2, the industry has spent the last 40 days in a state of controlled panic. But this week, the grace period ended. As lower courts begin remanding hundreds of cases for trial, the era of check-the-box vetting is officially over. If your carrier selection process is automated and cached, you are a sitting duck for a nuclear verdict. Here is the breakdown. The case involved a catastrophic crash in Illinois, where a driver for Carib Transport 2 struck a stopped truck. The broker, C.H. Robinson, was dragged in because Carib had a conditional safety rating and a history of HOS violations.
Wait, so the broker is now on the hook for the carrier's bad safety record?
Precisely. The court ruled that brokers have a duty of ordinary care. You can't just rely on a software screen that says active insured and call it a day.
That's going to put a lot of pressure on the dispatchers to actually look at the data.
It's more than that, Buck. It's a forensic requirement. If you ignore a red flag in the safety data, you're potentially liable for millions in a jury trial. The FAAAA shield is gone.
That sounds like a nightmare for the big brokerages.
It's a nightmare. It's the end of the blind trust era. Iron Lady's Verdict. That's a wrap.
All right, let's hit the main event, the mid-year financial pulse. FedEx just dropped their Q4 results, and they absolutely crushed it.
$25 billion in revenue? That's nearly $1 billion over the estimates, right?
Exactly. And an adjusted EPS of $6.31? The One FedEx consolidation is actually working. They've got 45% of volume flowing through co-located facilities now.
I mean, the thing is, they're slashing capital intensity to 4% of revenue. That's the lowest in their history.
Bottom line, they're not chasing volume anymore. They're chasing efficiency. And the spin-off of FedEx Freight on June 1st gave them a $4.1 billion cash dividend.
And yet the stock dipped 6% in after-hours trading. Investors are terrified of stranded costs.
Right, because the market is worried that the efficiency gains are just a temporary peak. But look at the free cash flow. $4.7 billion for the year. That's a war chest.
It's the same trend we're seeing with the trailer surge. Everyone is slimming down and scaling up strategically, sort of a quality over quantity phase.
I'll believe the recovery when the rates hit the street, but a $4 billion dividend is hard to argue with.
It's a strategic rebuilding phase. We're moving from a recovery to a scaling era, and FedEx is just the canary in the coal mine for how the rest of the giants are going to play this.
That does it for us today on The High Road. We saw FedEx crush their numbers, and the legal shield for brokers vanish into thin air.
Later!
See ya.
Bye.
Keep the wheels turning, folks.